Hi, I'm April Lois from Investor Relations at Wilson Asset Management, and today I'm joined by two members of the WAM Income Maximiser investment team, Matthew Haupt, Lead Portfolio Manager, and Damien Boey, Portfolio Strategist. So Matt, in a few sentences, can you explain what WAM Income Maximiser is and why it's unique?
I'll try, maybe not a few sentences, but we'll see how we go. The way I think people should look at WAM Income Maximiser is it's a combination of having debt and equity together. And the reason why we do that is really a few reasons. It's diversification, but also the benefit we have of having a debt sleeve and the freedom it gives us on the equities. Rather than having style bias within the equities, we can actually pursue different equity regimes through the cycle. So for us, the combination is quite powerful. From a risk-adjusted perspective, it's powerful, but it also provides capital preservation potential in a downturn. So the combination is a fantastic thing to have.
Damien, how might WAM Income Maximiser provide diversification in an investor's portfolio?
Yeah, that's a great question. So in the first instance, it's obviously adding debt to equity. So if you're a person who only owns equity, then having another asset class which doesn't exactly move in lockstep will offer you some sort of diversification benefit. It will smooth out your return profile. But more generally, what we're finding in the last few years and decades is that much of the world has switched towards investing in what you call long duration growth. What that means is that people are positioning for longer interest rates, lower for longer inflation, and they're really starting to value cash flows that they could get from companies out 10 years, 20 years, rather than things that they can see today. Now, I'm not saying whether that's a right thing or a wrong thing, but what you can see in markets is that we really have tilted very far in favor of that way of thinking. So if on the other hand, you have a product like Income Maximiser, which is actually very focused on getting you dividends and cash flow today, that will obviously be a very different sort of product to what the crowd is following and offer you a very natural source of diversification.
And Damien, back to you. The benchmark is 60% ASX 300 accumulation index,
yes,
and 40% Bloomberg Ausbond Bank Bill Index, plus 1%.
Yes.
Can you explain a little bit more about what this benchmark is and why it's
Yes.
relevant for shareholders?
Yes, absolutely. So we've done a lot of testing through time to see what is sort of the ideal portfolio over many, many cycles in Australia. And what that process generated was a portfolio that is 60% equities, and in particular higher yielding equities, and 40% debt. But of the debt, it's largely corporate bonds, stuff that's issued by companies and banks as opposed to the government. And we worked out that this is the best way to maximize your returns through the cycle while also reducing the risk and emphasizing the importance of franked income. So that's how we came up with that structure. So our benchmark, or what we judge ourselves by, is a portfolio which is 60% on equities and 40% on debt. Now, we measure the performance of the equity side using the ASX 300 accumulation index because that represents the universe of stocks that we're allowed to invest in. As for the debt side, what we've done is said, look, the Bank Bill Bond Index, the Ausbill Bill Index, which basically tracks a little bit above the RBA cash rate, we're offering to give basically a 1% premium in terms of the return that we generate over and above that. And that's really trying to showcase that through active management and the sorts of securities that we select, we do think we can actually do better than cash. So 60-40 basically reflects a neutral position for us through the cycle. If we were to invest 60% in equities, 40% in debt, that is the benchmark by which we want to be judging our performance.
And Matt, how is WAM Income Maximiser able to pay a monthly dividend to shareholders? And do you anticipate capital gains in addition to the monthly dividend?
100%. The way we envisage paying the dividend or monthly dividend is really through that high running yield we have versus like the other suite of WAM LICs. I mean, that's a real big difference is the WAM stable of listed investment companies we have pay a lot out of capital growth. You know, we're sort of turning the tables. This one pays a lot out of income received. So the way we do that is through having a selection of tier 2 bank debt, which is paying, you know, high 5% returns at this point in time. but then combining it with equities gives us that capital growth potential. So for me, it's the best of both worlds. You're getting an income, but you're not leaving capital growth on the table. And it's our job to find the appropriate markets to go long equities and capture that capital growth, but then conversely pull back on the equity exposures when there is times of turmoil and go into capital preservation mode. So for me, it's a great product, and you get that ultimate combination between income and capital growth.
And so you've both looked at macroeconomic indicators and debt and equity markets for decades. How does WAM Income Maximiser allow you to, I suppose, apply or express your views on things like inflation and interest rates that you couldn't do in a 100% equity portfolio? Maybe we'll start with Matt.
I mean, yeah, like you say, I actually started life as a multi-asset manager, so this is very, very familiar to me. And for me, it's just having the levers or the assets you can express your ideas in the most pure manner. Obviously you manage equities for about 14 years, solely equities for a long period. Quite often you have the macroeconomic thematic going on in the background, and you have to find a highly correlated asset which has its own idiosyncratic issues. So quite often you might get the thematic right, but then the stock you pick to reflect that thematic has its own issues and then wipes out your trade, and you do all the hard work and thinking and you don't get rewarded, or actually go in reverse. So for me, it allows the most purest form of expression, which is really refreshing. When you have a view on rates, which you try and translate through equity, sometimes, like I said, it doesn't work, and the equity market can't see it. So it's really having the combination, or having the toolkit to express those ideas.
Yeah, and I might just add to that as well. When you are investing as a macro person in equities, to highlight Matt's point, you really are looking for proxies, but proxies by nature are not perfect. And so part of the diversification of investing in equities and debt is recognizing that you might have a source of information in the debt markets which will completely structure your worldview as to how you would buy stocks, but there might actually be some time difference in between the time that the debt trade materializes and the time that the equity trade materializes. So if we want to get much more precise, or if we want to position for the trade at multiple levels, it's really important that we have all the levers to be able to do it. As Matt was saying, this is not stuff which is new to us. Like, we would have been monitoring these signals anyway, particularly in equities land, but now we actually have much more opportunity to be able to express the views at different time horizons and in a much more timely way.
Can you give us an example of how the debt and equity sleeves work together?
I mean, a great example is Centre Group, a company we've followed for many years. Recently, they were doing a big a debt raise, so we got to watch the book build, we got to watch the pricing, we compared it to their average cost of debt. We knew there was a big reduction coming, which essentially was a 1% EPS upgrade for Centre Group. So we got this information where other people aren't watching this. So I mean, that's a great example of having the debt sleeve and the synergies we get from having it. We get to see a lot of the moving parts, which we normally wouldn't see if you're an equity-only investor. So that was a great example of how we actually made money for investors.
Damien, if there's a big shock in the market, for example, US President Donald Trump announces new tariffs on China, how can you pivot the WAM Income Maximiser portfolio to benefit shareholders?
Yeah, so as Matt and I have been talking about, you have multiple levers in this portfolio. So we can change the asset allocation mix in between debt and equity. We can change the shape of the debt portfolio. So we can take higher credit risk or lower credit risk. We can take on more duration, so buy bonds of longer maturity or fixed rates versus short ones. And then we can also change the stock selection. So there's multiple levers. If it were, for example, an inflationary shock, then an inflation shock by nature would make you very skeptical of taking longer duration risk. You might want to be a little bit more positive on credit risk if you think that there's pricing power for companies. Within the stock market, you'd be looking to only be in companies that are able to perform robustly in a high inflation environment. So they need to obviously be somewhat insulated from higher interest rates. They also need to have an element of pricing power. And Finally, we have to look at how the different asset classes are moving together. So if you're in an environment where bonds and stocks are moving together and you do have an inflationary regime, then what you would find is that there's probably going to be a bit of valuation pressure on both. So therefore, you need to be in stocks and bonds, which are a little bit more defensive in that environment.
And when you talk about credit risk, WAM Income Maximiser primarily invests in investment-grade corporate bonds. Is that right?
Yes, that's right. So in terms of Moody's or S&P ratings, you can go from AAA all the way out to C or even D sometimes. We're not interested in the C's and D's. We're not even interested in a lot of the B-rated stuff. We're mainly hunting around AAA to high B-rated debt.
Matt, in an RBA cutting cycle like we're in now, how can you position the Income Maximiser portfolio to maximise returns for shareholders? And what if we were in a rate hiking cycle?
Great question, and there's actually a few different ways. Quite often people talk about a cutting cycle or a hiking cycle and how to position, but you really got to dig a little bit deeper, like why are rates being cut or why are they being hiked? And the delta of economic activity, because you can effectively cut a cutting cycle up. I look at it four ways, where you're either got ISMs or PMIs, which are like surveys of economic activity. They could be below or above the 50 threshold, which is either expansionary or contractionary, and then the change in direction of those. So it really depends on where you are on that economic cycle and where the cuts are coming in. So let's just say cuts are coming in and economic activity is picking up, we'd go long stocks, like you'd move the asset allocation towards that. If it's contractionary still and rate cuts are coming, we would be underweight stocks. So it really depends. It's quite nuanced how to position. Quite often you see in the media, rate cuts are coming, go long stocks, but it is nuanced. So it really depends on where we are in the cycle and a whole lot of other factors too, like liquidity and positioning, working that out as well, which is something we do, which I think is one of the advantages. We spend a lot of time on positioning as well as liquidity, the plumbing, which I think gives us that edge versus some other funds as well. So it's really just a combination. We do know what levers to push in which environments. The hardest thing is picking what environment you're in and where you're going to, but we spend all our time working on that.
I'll just add also on a hiking environment, we experienced this a couple of years ago when the Fed and every other central bank were in the process of raising interest rates. Credibility for central bankers matters a lot. So if they're raising interest rates and it's broadly in line with where the fundamentals of the economy are, typically you'll find that the equity market can be relaxed about that. But if you're in a situation where the fundamentals, growth and inflation, have really run hot and the central bank has kept interest rates too low for too long and there's a long way to catch up, actually there's a loss of credibility there which can really hurt more expensive stocks. So it's really important not just to judge interest rates per se, but as Matt was saying, the context and also the credibility of the central bank.
And Damien, what's the difference between fixed and floating debt, and what does WAM Income Maximiser invest in?
Yeah, so you can think about fixed rate debt very much as I go to the bank and I decide to put my money in for a long-term deposit of say, a year plus. In the context of bonds, a fixed rate debt instrument is going out 5 to 10 years and saying, I agree to be paid a fixed amount throughout the life cycle of that bond. A floating rate note is one which is much more like a variable rate deposit, where I go to the bank and whatever the bank's willing to offer me on the day, I'm willing to accept. So a floating rate note, and they're typically offered by corporations, is one where they promise to offer you the RBA cash rate plus a little bit of a spread. And as the cash rate moves up and down, the interest rate that you get moves up and down with a quarter or so delay. So that's a floating rate note. Floating rate notes, because the interest rate risk is basically completely mitigated, you're not taking on a fixed exposure for a long time. You're not at much risk of getting the interest rate wrong relative to the market. So they're what we call relatively short duration instruments where you're not really taking on interest rate risk. Whereas a fixed rate note, because you are locking yourself in for a long time and you could be wrong-footed by what happens with actual interest rates, that's what we call long duration risk. What do we invest in WAM Income Maximiser? We invest in both. Our benchmark is effectively something around 2 years duration in terms of the duration or maturity profile of the debt that we hold. We can make that up with a combination of fixed or floating, but typically we make it up with more floating.
I guess a great way of bringing it back to the normal situations with people's home loans. You can have a fixed rate home loan or a variable rate, and we're essentially buyers of the other side. So we receive the variable interest rate payments, or we can receive the fixed interest rate payments from a mortgage, which is a very easy way to look at it.
That's helpful. And Matt, what are hybrids, and why do some people consider WAM Income Maximiser to be similar to a hybrid?
I guess a hybrid by construction is meant to be, a little bit of debt and a little bit of equity. I mean, it's essentially debt, and can have equity exposure at the worst time when the banks are in trouble. They can convert it to equity, and I mean that's the real reason why the RBA or APRA, really didn't want to have these instruments around, because they were figuring people didn't know what they were investing in. Like it actually, at the worst time when banks were in stress, they could call on the instrument and turn it into equity. So there's a little bit of protection there, but like when it relates to WAM Income Maximiser, it's really that combination of having debt and equity. It's that combination which essentially is like a AT1, which is the bank hybrid. So you can see there is some relevance. It's not a like for like, but what we're trying to do, the outcome is very much like a hybrid where you get a fully franked, but this time it's monthly, not quarterly income. So we like to think of it as an enhanced hybrid where we're managing the interest rate risk for people. With a hybrid, like we were talking about the floating and fixed, you essentially at risk of interest rate movements, because let's say you go into a really big cutting cycle, your income's going to fall. Our job is to make sure your income doesn't fall, and we do have the levers to protect that.
What are your backgrounds and experience in debt and equity markets? Maybe we'll start with you, Matt.
Sure. I started off my career as one of my first jobs was actually a bank bill trader. So it sounds a little bit more glorified than it actually was, but I essentially would do bank quotes and trade the short-term cash book at my first job, which was in Adelaide for a period, and then progressively moved up through the organisation and turned eventually to a portfolio manager on a multi-asset fund. So it was a discretionary account managing about 300 million and had full discretion. So it was a multi-asset. I'd construct fixed interest, equities, a little bit on FX, but generally they were the three big asset classes. So did that for about 6 years. So had and traded through the GFC, so got to experience the best and worst of debt markets and equity markets, and then progressively moved to an equity-only role, which I've been doing currently now for 14 years. So this is just a natural evolution of going back to my roots, which, like Damien touched on, the way we view the world is completely through a lens where the asset class actually doesn't matter. It's just how you express those ideas. So even within equities, the way we view the world, the way we model the world hasn't changed. We just have the beauty or the option of additional asset classes, which is fantastic. So all up about 20 years experience through multi-asset and equities.
And Damien, what about you?
One of my first roles was working at the Reserve Bank of Australia, and I worked in an area in financial markets group which was particularly focused on the RBA's bond portfolio and its foreign exchange portfolio. So a lot of the work and experience that I've had has started out in that. So that was covering US Treasuries, European government bonds, Japanese government bonds, with some flow on impact for domestic markets and domestic bonds. And then obviously a lot of work done in terms of currency, focusing on the Aussie dollar, but obviously looking at all the majors. So that was where I started life. After I left the RBA, I went to work at Credit Suisse, and for basically about 17 years or so, was taking a lot of that know-how and a lot of that modelling and a lot of that experience, but applying it to a completely different universe in equities. So I was helping with equity strategy and then eventually running that sort of franchise. Moved over to Barrenjoey, in the last 3 years and have continued to apply that trade there. So my entire experience has basically been, if you want to describe it in a simple way, what you would call multi-asset, where you have the core macro views, you know what's actually making the machinery of the global system work, and you're just looking for the best ways to express your views, whether in equities or in debt.
What's a day in the life like for someone in the WAM Income Maximiser investment team? Maybe we'll start with you, Matt.
Yeah, thankfully we love data. We watch all the data around the world. We're watching every release for signaling, positioning, and responsing with thinking, how can we make money from this? So it can be a very long day cycle, but we love it. So we don't even think of this as a job. We actually love it. And both myself and Damien, we are very active at night when the data comes out, and we collaborating views and making sure, when there is an opportunity, we capture it at any time of the day.
And what about you, Damien? What do you do when you're not messaging Matt late at night?
Look, I just want to reiterate what he's saying. Like we love watching how the world evolves in real time, and there's no substitute for being there in real time to experience it at the same time as other people in other time zones are experiencing it. There are many examples where, if you're only trading in the Australian time zone, you'll go home in the afternoon, you'll see some data come out at night, you might have a think about it, and you might think that the market should respond a certain way, only to wake up the next morning and find that actually it hasn't mattered, or the market has reacted in a different way, or maybe in an exaggerated way. And all you can do in the morning is take the net learnings from the overnight session and apply them in the morning. One of the things that we can do with Income Maximiser is we can actually take positions outside of the Australian market time zone. And so that's hugely advantageous because we can be there for the over and the under reactions. We don't just learn from what hypothetically could or should or would have happened and apply it the next day. We can actually be there in real time. So that's something that we love doing, and that's something that we really apply ourselves and pride ourselves in doing. And it's a good test for us as well, because obviously when you're following that much data and you're working at that sort of pace, you want to make sure that your own convictions and your own reaction functions to data and developments are correct. So it's a great test, but it's a challenge that we love.
Matt, Damien, thank you very much.
Thank you.